evening. Today we are entering one of the most scoring yet most misunderstood areas of CAIIB BFM, derivatives and treasury. Many bankers feel derivatives are dangerous or too technical. But I want to tell you clearly, in exams, derivatives are not tested for mathematics. They are tested for concept, purpose and RBI guidelines. So today, we will learn derivatives like a story, not like a formula. So hello everyone, welcome here. I hope that you all are fine and doing well. Today we are going to do derivatives and treasury. So let's understand our concept number 1, derivatives and the role of treasury. Derivatives and role of treasury. Then you have to give answers after listening the concept. So imagine there is a very large Indian company has taken US dollar loan. Every month the company worries. What if US dollar become costlier? What if interest rate increase? What if cash flows become unstable? Now imagine a bank treasury sitting like a risk factor for the bank and its clients. What the treasury says? Treasury says, don't worry, I will transfer your risk to the market using the derivatives. That is where derivatives are born. Derivatives are the financial instruments whose value is derived from an underlying assets. Derivatives are the financial instruments whose value is derived from an underlying assets such as currency, interest rate, bond, commodity. Bank treasury uses derivatives mainly for 3 purposes. Risk management, where they manage all the asset liability management risk, where they manage interest rate risk, where they manage exchange rate risk. Client requirement, especially for corporate customers. Hedging the forex and interest rate exposure. Right? And third one is trading purpose. Taking trading positions, treasury profit generation is there. So derivatives are derived value instruments and treasury functions, risk management, client service, trading. It focuses on ALM risk and hedging versus trading. Right? So what is the primary use of a derivative by a bank? Treasury is to what is the correct answer according to you? So here simple, treasury mainly uses derivatives for the risk management, client hedging and trading, not for replacing loans or avoiding regulations. So which option is correct here? Directly we have the correct option, managing financial risk and client exposures. So option B is correct here. Now clear with the concept of derivatives? Now let's understand the second concept, then you have to give the answer here. Okay. Suppose a corporate customer comes to bank and says, I need a US dollar INR contract for 37 days for US dollar 3.75 million with special settlement terms. Bank says, yes, we can customize it exactly for you. This is called OTC derivative. Now imagine other person wants to trade US dollar INR like shares on a screen with standard size and daily margin. And that is exchange traded derivative. So what is the over the counter derivative? Which is privately negotiated, which is offered by the authorized banks, which customize the contract amount, date and terms. Bank quotes the price with the margin, and also here the counterparty risk exists. And what is the meaning of exchange trade derivatives? These are traded on recognized exchanges. Standardized contract size is there and maturity is there. Transparent screen based pricing is there. Exchange becomes the counterparty, and there is daily margin system which eliminates the counterparty. So if I say that what is the difference between OTC and this exchange traded derivatives. So simple, OTCs are the bank negotiated and exchange traded derivatives are based on happens on the exchange, right? Then in this, contract is customized according to the need of the client, but in exchange contracts are standardized, right? Then pricing here in the case of OTC quoted by the banks, but in exchange price are transparent, visible for everyone, right? Then here in the margin, we can say margin is in the case of OTC is banks discretion or banks ability, but in exchange traded derivatives there is daily exchange margin, right? In the OTC counterparty risk is present, but in exchange party counterparty risk is not existed. And why OTC is used? For hedging, but in exchange it is used for trading and speculation. So that is the difference between OTC and exchange. Now the thing is there that OTC means customized, bank negotiated. Exchange traded means standardized and transparent. Counterparty risk is available in the OTC, right? Or next, margining system is there, right? So the answer of this question, now you have to tell me. I told you the concept. What is the answer according to you? Tell me fast. Simple, yes. OTC derivatives are customized and negotiated directly with the banks, unlike standardized exchange contracts. So the correct answer is here option C. OTC derivatives are customized contract. Which option is correct? Option C is correct. OTC derivatives are customized contracts. Now let's see the third question. Future contracts are described best as. Now future contracts, let's see the concept here, which I am going to tell about types of derivatives. Types of derivatives means forwards, futures, options, swaps. These are the types of derivatives. Now types of derivatives, I want to tell you a story here. See, there is a businessman that wants certainty, right? Sometimes he wants certainty without flexibility. When he wants certainty without flexibility, that is called forward. Sometimes he wants flexibility with protection, that is option. Sometimes he wants market trading, that means futures. And sometimes he wants cash flow exchange, which is called swap. So all derivatives are there, all the types of derivatives are there in the market according to the need of the clients. So here, if I talk about the major types of derivatives, there are 4 types of derivatives are there which are major types. Forward contract, options, swaps and futures. Future is a standardized form of forward. Everything is same in future and forward, but future is standardized type, but forward is customized type. So four types of derivatives which are important: forward contract, options, swaps and future. Now what happens in swaps? Swaps are generally means cash flow exchange. What happens in forward and futures? Forward and futures, when any customer, when two parties agreed on same terms and condition, they do deal today, but they set the price today and do the settlement after 30 days or after a prescribed period of time according to the terms and conditions which are agreed between them, right? So basically future contracts are best described as here. Which answer is correct? Yes. Always remember this thing, that future contracts are standardized contracts and that forward contracts are customized contracts. These contracts are customized according to the needs of the customer, according to the demand of the customer. So that is the biggest difference between future contracts and forward contracts. So that's why future contracts are best described as exchange traded standardized forward contract. Option C is correct here. Got it? Okay. Now you got it, that how many types of derivatives are, what is the meaning of derivatives. Now here, forward contract is idle for which objective? Forward contracts are idle, but for which type of objective? So try to see that what is the meaning of forward contract. See, I am going to tell you. Forward contract. Forward contract means when there is the agreement to buy or sell a foreign currency. When there is an agreement to buy or sell foreign currency on a future date at a fixed exchange rate. Listen carefully. Forward contracts are the agreement to buy a foreign currency on a future date at a fixed exchange rate, and here execution is mandatory and it provides zero risk hedging. There is fixed rate, future date, obligation to execute and zero risk hedging. So a forward contract is idle for which objective? Obviously for hedging, but with zero risk. Hedging is like protection with zero risk. So option C is correct here. Right? Now, which option is unique to option contracts? Option contracts here, the fourth option is interest income. Okay, option D is interest income. Which option is unique to the option contracts? Which option is unique to the option contract? So let me tell you about the option contract. Suppose you pay a movie ticket. Now you have to right to watch, but if you don't go, no penalty is there. The ticket fee is like option premium. If you, it is your choice. If you buy a ticket, it's your choice. You do want to go or not. That ticket fee is like option premium. So now option contract, buyer has a right but no obligation. Buyer has the right but no obligation. Seller has obligation and premium is paid upfront. So call option is right to buy, and put option is right to sell. So in forward is mandatory, option is optional. In forward there is no premium, in option premium is payable. In forward there is a fixed rate, but in option best of strike or market price. Forwards are simple but options are flexible. Right but no obligation, option. Call, buy, put means sell, and there is a option premium. So which feature is unique here? Obviously upfront premium payment is the very unique thing is here. Upfront premium payment. Is that clear? Now let's talk about futures now. Future contracts are primarily used for. Future contracts are primarily used for. See, let's see the example for the futures. Suppose there are the stock traders who buy and sell the currencies. They trade US dollar INR like shares every day, right? They are doing trading of US dollar and INR every day. They don't want delivery, they want only the price difference. That is called future. Future contracts are standardized contract, they are traded on exchange, they are fixed price, fixed rate is there, and they are mostly cash settled. So they are exchange traded, they are standardized, the daily margin is there, and cash settlement is there. So future contracts are primarily used for, yes, for trading and as well as for speculation. So option B is correct here. Which option is correct? Trading and speculation. FRA. FRA is differ from IRS because FRA covers what is the meaning of FRA? FRA is forward rate agreement. IRS is interest rate swap. Forward rate agreement is the full form of FRA, and IRS is related to interest rate swap. Now there are two borrowers who sit together. One wants fixed rate, one wants floating interest. They exchange their cash flows. There is no principal charges, hence physically they just swap their cash flows. That is called swap. When the exchange of cash flows happens, that is called swap derivative. Interest rate swaps are the example of interest rate flows. Interest rate flows, and it is based on notional principle, right? It is based on notional principle. Now the thing is there that what is the meaning of that notional principle? What is the meaning of notional principle? So notional principle or notional amount is that face value of financial derivatives like interest rate swap, future contract, which used solely individually to calculate the interest or cash payments. They are not for the actual exchange of principal, and they determine the size of the position, and while it dictates the interest flow, it remains untouched by the parties which are involved. So that is the notional principle, and interest rate swaps are based on notional principle. But forward rate agreements, they are single future interest payment is there. In IRS there is multiple payments. Currency swap is completely depends on the exchange of cash from the different parties, right? So we can say there are three types of currency rate swaps: principal only swap, coupon only swap, and third one is principal plus interest swap. Principal only swap, coupon only swap, and principal plus interest swap, right? So why this FRA differs from the IRS? Because FRA covers what? simple answer is there that according to the option, because of single future interest payment in IRS there is multiple payments. So which option is correct? Option C is correct. Right? Now next question. ISDA master agreement is required mainly to ISDA master agreement is required mainly to what is this ISDA agreement? ISDA master agreement. So let me tell you about the ISDA master agreement. Actually, this is the agreement which is standard or globally recognized contract for over-the-counter derivatives. And ISDA full form is that International Swaps and Derivatives Association. They govern the transaction like swaps and options, and they basically establishes a single unified agreement for all the trades which happens between the two parties, which allowed them to which helps them to reduce the credit risk and also the standardized legal terms. So suppose RBI acts like a strict referee, right? So it allows derivative but only with rules and documentation. RBI issued comprehensive guidelines on derivatives. RBI which issued comprehensive guidelines on derivative. ISDA master agreement is mandatory. Documentation stages are ISDA master agreement, schedule and trade confirmation. Only those corporate who have board approved risk policies, they can use the derivatives, and bank have to follow suitably and appropriateness policy. So ISDA master agreement, suitability policy, RBI derivative guidelines and risk management policy. So ISDA master agreement is required mainly to what? Standardized derivative documentation. So option C is definitely correct here. Got it? That is the correct answer. Okay. Now, next question. FBIL is responsible for. FBIL is responsible for. What is the meaning of this FBIL and benchmarks? FBIL and benchmarks. So FBIL and benchmarks. See, simple. Market always needs a trusted referee for the rates, and FBIL plays that role. FBIL plays that role. Right? How? FBIL is the joint venture of FIMDA, of FEDAI and IBA. This is the joint venture. Now, what is the work of this FBIL and what is this? So, you can say that this is a financial benchmark India Private Limited, that basically a very good organization, important organization in the India's financial market, which are responsible for developing and administrating the benchmarks such as interest rate, currency rates. That is the work of the FBIL. Right? Now, FBIL publishes the benchmark like MIBOR, options volatility, certificate of deposit rates, IBA. That is the work of the FBIL. Right? So, uh, why this FBIL is responsible for? This is obviously responsible for benchmark rate publication. Option C is correct here. Which option is correct? Option C is correct. Got it? Now, derivatives are called derived instruments. Why? Derivatives are called the derived instruments, but why? What is the answer according to you? Now you are clear with the term derivatives. Very simple answer is there. They are called derived instruments because their value is derived from the value of an underlying asset. Underlying asset means the price of a derivative depends on the performance of an underlying entity such as stocks, bonds, commodities, currencies, interest rates, or market indices. So which option is correct here? Simple. Derivatives do not have any type of independent value. The value is derived from an underlying asset such as foreign currency, interest rate, bonds, commodities. For example, a US dollar INR forward contract get its value from the US dollar INR exchange rate. That's why they are called derived instruments. That's why they are called derived instruments. So which option is correct here? Option B is correct. Their value is derived from an underlying asset. Which of the following is most effectively managed by using the derivative? Which of the following risk is that? Which option is correct? So let me clarify that derivatives are designed. But why? Just to manage the market risk. Because market risk happens when the factors changes in the market and that factors become the cause of loss. So it includes exchange rate risk, interest rate risk, and price risk. Operational and legal risk are managed through internal controls and through the rules and regulations, but not by the derivatives. So which option is correct? Simple here, market risk is the correct answer. Option C is correct answer. Great. Got it? Why does OTC derivative contract involve counterparty risk? What is counterparty risk? When two parties enters into the agreement, one party fulfill their part of obligation but another party is not unable or fails to fulfill their obligation. So why do the derivative contracts involve the counterparty risk? Which option is correct here? So let me tell you. See, we know that OTC derivatives are privately negotiated contracts between the two parties, bank and client. If one party fails to honor the contract, the other party suffers a loss. So there is no exchange acting as a guarantor. Counterparty risk exists here. So which option is correct? Simple, we can say The correct option is option C, because settlement depends on the financial strength of the counterparty. Option C is correct here. Now, which feature makes exchange rate derivatives safer than OTC derivatives? Which feature makes the exchange traded derivative safer than OTC derivative? Simple. In exchange trade derivatives, exchange becomes the counterparty, and there is daily M2M settlement is done. Mark to market settlement is done. What does this term means, mark to market? Mark to market, generally it is a valuation method that adjusts the value of assets and liabilities to their current fair market price. They reflect real time market changes, which is crucial for transparency in the accounting, which is managing risk in trading and determining daily net asset value. It shows profit or loss as unrealized gains or loss on a daily basis. So, in this, we can say margins are collected daily. This eliminates the counterparty risk, which make them safer than the OTC derivatives. So, which option is correct? Simple, we have daily margining and clearing by exchange. Option C is correct. Next question. A forward foreign exchange contract creates which type of obligation? A forward foreign exchange contract creates which type of obligation? Simple answer. In a forward contract, both buyer or seller, they have to execute the contract at maturity, irrespective of market movement. This mandatory nature makes forward suitable for zero risk hedging but inflexible. For zero risk hedging but inflexible. And what is the meaning of this zero risk hedging? Zero risk hedging, you can say that when there is a very neutral positions in the market, by using option or futures that completely eliminates the loss from adverse price movements, right? So that is zero risk hedging. Now the thing is there that a forward foreign exchange contract create which type of obligation? So the correct answer is mandatory obligation to execute. Option C is correct here. Why is an option premium paid upfront by the option buyer? Why is an option premium paid upfront by the option buyer? C. Option buyer enjoys right without obligation, ability to choose the better of strike price or market price. The option seller carries the risk of loss, and therefore that buyer pays the premium as the compensation. So what is the meaning of this strike price and market price? See, always remember, strike price is fixed, that is predetermined price at which an option holder can buy or sell an underlying asset, remaining constant through the contract life. And Spot price or market price is the current price at which asset is actively traded, fluctuating constantly based on market demand. So the correct answer is here option C, to compensate the option seller for taking the risk. Option C is correct. Which factor does not influence option premium? Which factor does not influence option premium? Option premium. What is the meaning of that option premium? Option premium is the upfront non-refundable price a buyer pays to a seller to acquire an option contract. It represents the cost of the right but not the obligation. Why? To buy or sell an underlying asset at a set price before a specific date. And it is composed of intrinsic value and time value. And that is also driven by the market demand, volatility, and time to expiration. So option premium formula is intrinsic value plus time value, and that time value is extrinsic value. So which option is correct? Here which option not influence? Option premium completely depends on volatility, on strike price, on time to maturity, on interest rates, and forward premium is related to interest rate differential in the forward contract, not option pricing. So here the correct answer is forward premium. Option D is correct. Now future contract differ from forward contract mainly because futures are future contracts. What is the meaning of that future contract? Future contract, as I told you, standardized legal agreement to buy or sell any asset like gold, oil at a predetermined price but at the future date. They are traded on a regulated exchange to manage the price risk or speculate on price movements. So, future contracts are traded on recognized exchanges. They are standardized in size and maturity. They are settled through the daily margining. So, forward contracts are OTC and as well over the counter, as well as they are customized. So, which option is correct? Option C is correct, exchange traded as well as standardized. Now, currency swap type, coupon only swap. In coupon only swap, the borrower complete this statement. So coupon only swap means, yes, over the counter derivative contract where two parties exchange their periodic interest payments in the different currencies based on a set notional period, and they are not exchanging the principal. So in coupon only swap, principal remains in original currency, only interest payments are swapped currency risk on principle still exists, and this is the commonly thing that is used. So which option is correct? Option C is correct. Swaps only interest payments. Option C is correct. So which RBI requirement is aimed specifically at preventing mis-selling of derivatives? Yeah, RBI mandates bank to follow a suitability and appropriateness policy that ensures derivative products match the client risk profile. They have to understand the client risk, and mis-selling is avoided. Mis-selling is generally avoided. So that's why we can say RBI mandates that derivative product can be offered only to the corporate having a board approved management policy to avoid the misuse. So derivative means risk management tools. Treasury role is hedging, providing the client service and trading. Forwards are the obligation. Options are the right without obligation. Futures are exchange traded forwards. Swap is cash flow exchange. ISDA is a mandatory documentation. RBI is the regulator, and FVIL is the benchmark authority. Right. Now I want to clear one thing about one term is there, FIMDA. What is this FIMDA? See, that is a basically you can say this is the industry body that played a very important role in the India's fixed income, money market and derivative market. And the full form of FIMDA is Fixed Income Money Market and Derivative Association of India. So FIMDA is the industry body that plays important role. They include pricing standards, dispute resolutions and market reports. They set the benchmarks, they do the market development, they guides, they provide the guidelines and the policies, as well as they publishes regular reports and analysis on market trends and the developments. Right? That is the role of FIMDA. Clear? Now I hope that thing is clear, that what is the meaning of derivatives. Derivatives, simple, are the financial contract between the parties which derives their value from underlying assets like stock, bonds, commodities, currencies or market indices. There are common types of derivatives are forward, future, option, swap. Forwards are the derivative who are customized non-standardized contract between the parties and they are traded over the counter. Futures are the standardized contract based on traded on exchanges to buy or sell an asset at a fixed price or on a future date. Options are the contract that give the right but not the obligation to buy or sell an asset at a specific price. Swaps, derivative which is used to exchange cash flows such as interest rate swap. So derivatives are used by the investors, speculators, corporations to manage what? Exposure to the market volatility. So I hope now this chapter is clear. If you have any doubt, comment down and you can ask me out your issues. So just revise all the questions. Let's meet in our next class with next unit. Till then, take care and have a happy weekend. Thank you everyone.